everyone. I'm David Darst, here to give you a recap of the month of June. It was a momentous month. First of all, you had three things down. You had the dollar down, you had interest rates down, and you had oil down. The reason for the dollar being under some pressure is that the fear bid, after the conflict had calmed down, the fear bid began to be unwound. People had fled into the dollar and driven it up a little bit, and then they began to withdraw again. Secondly, you had a spike in continuing unemployment claims. That means it's more difficult for people to find a new job. Layoffs have been quiet, but finding a new job, if you have been laid off, has become difficult. And then there's been this talk of a potential naming already a replacement for Fed Chair Jay Powell. And that has basically, people feel that whoever that is, man or woman, that he or she would tend to be more dovish or more inclined to start lowering interest rates. So that's the reason number one that the dollar was down. Secondly, interest rates were down. You had the core and the headline personal consumption expenditures index still down. The headline 2.3%, which is obviously helped by oil being down. The core 2.7%. So they basically stabilized here, but they're much lower than they used to be. And your house prices have been under some pressure as that feeds into the rent numbers and, of course, to the consumer price index. So that's a second reason that you've had interest rates down. And thirdly, the economy is continuing to moderate. Retail sales, the ISM manufacturing, ISM services, they're all showing a slower rate of growth than they had been going. And finally, oil down. Obviously, the classic reasons, demand softening, China, Europe, U.S., demand softening, and the supply continuing to advance, continuing to increase, and the threat of an interruption of the supply being removed as tensions have calmed quite a bit. Stocks right now, publicly traded stocks, are discounting a soft landing as they've made record highs in the month of June, as you know. Bond yields, however, as they've been going down, they are giving a slightly different message, and that message is a continued moderate growth and maybe even a slowing in growth. The S&P 500 was basically up 4.4% for the month. It's up 24% from the April bottom, with the April sell-off after the Liberation Day announcement on April 2nd, and then it bottomed out around April 8th, April 9th. So it's up 24% since then. NASDAQ for the month, that's your technology, up 6.1% for the month of June. Russell 2000, which is your small and mid-cap companies, mainly domestically oriented companies, up 5.1% for the month of June. The bank stocks year to date are up almost 9%, 8.8%. Europe is up 7%, but don't forget the euro is up 13% against the U.S. dollar. So in dollars, if that's the way you're keeping account of things, you're up almost 20% in Europe. Japan up 0.6% year to date, plus another 6 or 7% gain in the Japanese yen versus the dollar. So you're ahead of the game there. China up 2.2% year to date, with the currency up 1.7%. In the bond market, the two-year Treasury closed the month somewhere around 373. It was down 16 basis points. It started the month at 389. And the 10-year 429, it started the month at 441. So it was down 12 basis points. Gold, as things calmed down, gold was up only 0.1% for the month. It's up 24.5% for the year at 3,293, something like that. Oil had a tough month, basically closing at 65.52. It was up 7% for the month, but for the For the last week of the month, it fell 13%, and oil year to date is down 19%, even though it had this recovery. The dollar down 10.4% against a broad index of developed market currencies. Year to date, you've got Nvidia up 18%. You've got Microsoft up 18%, and you've got Meta up 28%. These are the three of the Magnificent Seven. The other four are not doing so well. Apple is down 20%. Amazon is up only 2%. Google, that's your Alphabet, is down 5.7%. And, of course, Tesla is down 19.7%. Basically, what is the market telling us right now? It is saying that there's very slight chance of a recession. It is saying that the tariff damage will be able to be managed. That's what we've been worried about. Tariffs causing slowing in economy and higher inflation. That's not a good combination for market prices, public market prices. Peace in the Middle East, passage of the big, beautiful bill that they're talking about in Congress, the tax cut of 2017 looks like it's going to be continued, not further, but they're going to keep it as it was. And the Fed, people expectations, the market is pricing in expectations of maybe 2 interest rate cuts between now and year end. The risks, of course, are number one, that these tariffs, again, get out of control, and that hurts the economy and inflation goes up. So right now, markets are saying we don't think that will happen. I think there's 4 reasons the market's been able to make new highs. Number one, the administration. The bark has been much less than the bite, meaning the words are there and then they tend to back off a little bit. That's reason number one. Number two, no stagflation. That means the economy could continue to grow, maybe more modestly, but inflation not getting out of hand and no big drop-off in the economy. Number three, artificial intelligence enthusiasm has returned. It's been amazing how the flow of information about artificial intelligence spending, artificial intelligence. People have been using it more and more, and I think that has filtered into investor psychology. And of course, lastly, now that we're about to enter July here, you're using $260, $265 for the S&P 500 earnings for 2025. But then now people start to price the S&P 500 on 2026 earnings. And there you're talking about $290 to $300. And that basically reduces the PE from 22, 23 times to around 20, 20 and a half times. So the valuations are not as we start to think about this, if those numbers can be achieved, the valuations are not as onerous or as exalted as they and elevated as they seemed. In terms of our positioning, we believe that you really, this is a time to look carefully at private credit, where you can achieve some income, especially in collateralized loan obligations of debt, collateralized loan obligations of equity. In private equity, there you see many of the endowments, universities, foundations are selling some of their very, very good partnership interests. They need the liquidity right now, and that creates opportunities where you have managers and sponsors who are able to find. And these portfolios, you know what's in the portfolios. That's why we've emphasized secondary market interest in private equity, and of course private real estate. There you want extra selectivity. Pay attention to where you are in the capital structure, and again, manager and sponsor selection is key here. Thank you very much for being with us. We look forward to catching up with you very soon.